joining in, and we also have another guest joining in. We also have Mr. Manish joining in. Warm welcome to Manish and Nishal. Warm welcome to both of you, and thank you so much, sirs, for joining right in. Manish, sir, first up, of course, we've been looking at the fine print and gauging the impact of 26% versus a 34% on China and versus higher tariffs on the other countries as well. I want to understand one key point from you. If we're thinking of whether India has a chance to negotiate, bring this tariff down, maybe it is possible in the days to follow, months to follow. But if it is not going to be just India, the impact that government sources are already telling us will be largely felt by what happens on a macro economy point of view, what happens worldwide. If that really slowdown happens, if a recessionary impact happens in the US, then how are we going to get indirectly impacted? Tell us your first thoughts, sir.
Yeah, so that's the second order impact, and it's a given that in the short term, US is going to feel the heat on growth because supply issues cannot be addressed in the short term very quickly. So there will be a hindrance for the American consumers to purchase with increased prices on account of tariffs, and that's going to basically manifest itself in the form of either stagflation and even 35-40% chance of a recession coming through. That's a second order impact, and the global fallout will be seen across the board, across the countries. That's a given. And obviously, India will be not immune to that aspect as well. So we have to live with that. I mean, if manufacturing has to come back to the US, it can only happen in the medium term. Repercussion of all this is going to happen on currencies. Obviously, US dollar is going to be feeling the pressure of either a stagflation or a recession coming through. And vis-a-vis major trading currencies of the world, the yen and the euro, it might weaken. And that's again going to have a second order impact on exports and imports in a big way, apart from the tariff issues which has just now got unveiled.
Right. Namaste, Nishchalji. A very warm welcome to you. We will need all the wisdom and all the knowledge at your disposal over the last 35 years that you have gained on how to navigate this intense volatility that is now upon us because of this global tariff war. How do you see Indian markets, and what are the opportunities and threats that are upon us?
Thanks for inviting me. Thanks, Alice. I think one thing is becoming clear basically that there is going to be increased volatility, not only in terms of the market, but also in terms of the business across the world, as the US has now started with a unilateral announcement, and then it's going to go in for a bilateral agreements across the world with different countries. I think that is their plan, and I think that's what they are going to eventually do. But that will happen over a period of time, and that will create uncertainty. And I agree with Manish that there is a fair chance that US may go through a stagflation, basically maybe a quarter or two of recession, and that will impact the world across basically, as US still remains to be the major consumption bowl of the world. Now, how do you play this basically in this time of uncertainty, at least for the next 2 quarters? What I see here is basically two things. One is focus on domestic industries, which are largely India facing, and there are several of them, and they are doing okay. I think whether it is one of the major ones is basically government's spending. So whether it is the beneficiaries could be cement, beneficiaries could be construction, beneficiaries could be construction equipment guys. So I'm saying there are several of these industries which are domestic facing, whether it is consumption, retail. I think there are a lot of industries basically which are totally domestic facing. So focus on that. India that way is a fairly insulated in country. I think 22% of their India's GDP is exports. There also I think pharma and IT has been spared. So something silver lining. So in the next 2 quarters, focus on the domestic side, focus on individual companies, because even within these sectors, as we have seen, India is going through a issue as far as earnings growth is concerned. So you have to be very, very focused. but avoid international export companies which have too many linkages abroad. I think in the short term, just avoid them, because yes, there may not be any direct impacts, but the second level impacts could be many.
Fair point. Mrs. Sonthalia, I'll come back to you. And I want to understand from you, how would you play a pharma vis-a-vis auto at this point in time? Seems like it that pharma has been left out, and that is, displaying a clear win kind of a move at this point in time, a relief kind of a move at this point in time. But looking at how the fundamentals have played out, this may be just a trigger of a relief. But do you really see from here on pharma will continue to give you additional upside, or should one not go all guns blazing on pharma, looking at just this tariff relief that has come in vis-a-vis what happens on autos? Those are the first segments or the sectors that have that 25% tariff going right from tonight. The first hit sector is auto at this point in time worldwide. So how would you play pharma vis-a-vis auto now?
So, before I answer that question, one additional important point that I would like to highlight is that China's duty is around 54%. India's duty is going to be 26%. So, I would broadly think that this is a golden China plus one movement for India. If with a differential duty of 28% between China and India and a purchasing power parity of 2x that of China, if we are not able to increase our share of global trade with the US, then we'll probably never be able to do.
Okay.
So, this is an opportunity in the making. Coming to the question of pharma, I mean, it was very clear that, pharma could not be taxed, given that the cost of manufacturing of pharma in the US is multiple times that of what it is in India. And if Indian guys are not able to make 20-25% ROC exporting to the US due to price erosion and other things, American manufacturers are in no position with the high cost of manufacturing to cater to their lower cost of Medicaid. Cost of medical is all very high in the US. So
Yes.
I think, so pharma is clearly going to be a beneficiary, and India's share is only going to go up because China is facing massive issues on that count. But we have to be mindful of the second order impact of the excess capacities that exist in China, and what sort of non-tariff barriers do they exercise in the case of KSMs and APIs, of which India is a big importer, and we make the formulations and export to the US. We have to be mindful of two aspects. One is the dumping of Chinese products into India, destroying industries worldwide because they will be left with excess capacity, and because they won't be able to export that much that is there going to the US. And the second is basically non-tariff barriers in terms of creating embargoes on important raw materials catering to some of the industry. Automobile is going to be a clear disadvantage, not so much in terms of volume, but more so in terms of EBITDA margins, because that is, and this is basically both autos and auto components. In some time, we'll see that. But India really does not export too much of OE products, which is the manufactured cars and motorcycles, etc. It's basically the auto-com space, our US, and engineering goods. These are some of the areas which can get negatively impacted because of an immediate announcement of this 26% tariff.
Sure.
So key vulnerabilities are basically auto and capital goods, according to me, given that India exports around $87 billion, four major items: gems and jewelry, capital goods, autos, and pharma. These would be some of the key items. Pharma has been exempted. Gems and jewelry, we re-import them, and the two left outs will be autos and capital goods.
Fair point. Nishal sir, just wanted to get a sense going. The reaction in the market is probably saner than what we were, expecting. What do you make of that? 23,259, we're not as bad as we had, were thinking to be. Do you think the worst of the tariff impact is already priced into the markets? What we've seen in the run up to the April 2nd announcements, I mean, from February onwards, the kind of fall that we had been witnessing in the markets. Do you think the worst is already priced in, and we are now on course on our own fundamentals and domestic recovery triggers?
So I think it's too early to say that because US and Mr. Trump, he might do whatever he wants to. So it's too early to rejoice, but it's a big relief basically because after seeing yesterday's, because the tariffs are much aggressive than what market was expecting, and then there was reactions across the world. I was expecting at least the Nifty to open at closer to 23,000 rather than actually 23,200. So it's a very good relief. But it's too early to say that only the fundamentals, we need to worry only about the fundamentals because I think this is just, as I was telling you, it's just opening the table. And now I think the broader bilateral negotiations will happen. I think India is already on the front foot there. The government is negotiating early there. So I see a positive outlook. I see a positive outcome of that. But I think it's a bit early to rejoice.
Early to rejoice at this point in time. Mrs. Sonalia, I'll come to you as well. In case we are working with that, volatility may continue. We may see a lot of announcements even after today on tariffs, and uncertainties could perhaps keep coming in as headwinds to the recovery path that we are on the Nifty. Then, how would you advise an average retail investor to really continue to focus on building that crisis resilient kind of a portfolio and keep your eyes on the long term and let things pass at least for the next few months?
So the big call is that the US dollar is going to depreciate, and obviously, India is going to have a second order impact on the currency. Indian currency was depreciating massively, and that has obviously halted due to the depreciation of the dollar index. And I think this is basically the main reason why emerging markets are holding out. Now, there is one school of thought which believes that equity risk premium across emerging markets may go up. But there's another school of thought which believes that because the US is going to see a massive depreciation in their currency, there can be a shift out of dollar assets and move into other assets across the world. There is a case of decoupling. Obviously, we have never seen this sort of a massive decoupling. But mind you, in domestic markets, we are looking at two major rate cuts coming through in April and June. That's going to be a silver lining as cost of capital comes down. 23% of our exposure of GDP is on account of exports. Balance is all domestic. We produce and consume domestically. That's not impacted at all. And within that merchandise exports, it is just about $87 billion worth of exports. And obviously, government is on the job to enter into bilateral agreements because US is just bothered about reducing the deficit with the surplus with India, which is around $47.5 billion. If we were to shift our energy import basket from, let's say, other countries to the US, obviously that problem will be solved. And it's a solvable problem, according to me. It's a matter of time. So I think it is a golden moment. It's a buy on dips. I would strongly stick my neck out and believe that 22,000 on the Nifty might be defended very well, given that domestic flows are still very good. It's still about 30,000 crores in the month of February when there was all gloom and doom all around. Retail participation is there. And, I would believe that it's a golden moment for India. Everybody is in the same boat as far as the reciprocal tariffs is concerned. We are not that badly impacted as the likes of China, Vietnam, Thailand, Indonesia. If we can compare themselves to us, then basically we have a clear advantage and an opportunity. I think Indian corporates and manufacturers will take care of this and seize the opportunity. I would be basically quite bullish on the markets from these levels and, would look to buy on the dips. I would believe consumption is the mainstay. The next leg of growth in Indian markets will come on account of consumption. BFSI and pharma, these are clear standout winners as far as the today's announcements on tariffs.
Okay, hold that thought there. I'll come back to you on the three sectors that you've named, consumption, pharma, BFSI. Those are the places that you believe things could shift to. But Nishchalji, I also wanted to get a sense. We've seen a reaction on gold that continues to rally, looking at all these uncertainties and as how talks have progressed on how slowdown could occur, inflation could rally, everything that sounds good for a gold bull. What would you really, look at the current space and the levels that we are on gold, and would you at all be extremely bullish, or would you be cautious after the rally that we've already seen on gold?
My comment on that would be at best a guess. I am no expert on gold. I only understand or or claim to understand equities. That's all. But I would say I think something which has rallied so much. I think there is going to be some reaction, some profit taking would happen. I would say, given this kind of uncertainty, one should remain invested in gold. But incrementally, as an individual investor, I would tend to put more money on gold at the moment because things are changing as we expect dollar to become weaker. I think things are going to be not in favor of gold as we go along. So I think hold on to your positions because there is still uncertainty, but incremental investment should be done in gold.
Okay. I'll want you also, Mr. Sonthalia, to talk about how would you really look at, precious metals, because we've been hearing in the run-up to the rally that we've seen over the last 2 years odd or so that the gold and silver now at least should be a part of the core portfolio, have 10-15% kind of an exposure in case you're a long-term investor. What exactly is your thought here?
No, so I'm quite bullish on the precious metal space. I would believe that the US dollar has a case to depreciate at least 5 to 10% from these levels. And obviously, if the dollar depreciates, then and there is an environment of stagflation in the major growth engine of the world, which is the US, 25% of world's GDP, then obviously gold and silver acts as a safe haven to protect your asset value. Central banks all over the world are piling onto gold. And I would believe that the precious metal, gold and silver have further upsides from the current levels. God knows where they can head to, but they can surely be upside from the current level.
Okay. Nishilji, coming back to you, tell me, after the overnight announcements on tariffs, does anything change for an investor who may be looking at a global diversified portfolio? How will things change if you yourself would look at an allocation globally now?
So I would actually pull out money across the world and say, come and invest back into India,
Wow.
because that's where you are safe at the moment. India is a fairly insulated economy. Look at the domestic plays which are still doing well. By the way, India still continues to remain one of the not one of the, I think the top most performing economy as far as GDP growth is concerned, that has been projected for the next year. So I think if you want to see growth, I think there are very good companies out here. So I think pull out money across because that's where there is huge amount of uncertainty. Other countries how they are going to react, because I think this is just a one-way tariffs basically with the US export. Now we have to wait and see how each of these countries react to it. So that's the problem basically, and that's why I would actually pull out money, because at least we are very clear about what is the stance of the Indian government. So pull out money across and come back to India.
Pull out money across and come back to India. India is your best, place to invest in at this point in time. And Mr. Sonthalia, if I have to ask you as well, how would you really look at FII's position now? They have been net sellers of the Indian equity markets. Do you think these fresh triggers will provide a case for them also to return to India?
100%. I mean, there have been big sellers in the market over the last 1.5 years, and the key reason for the selling was the overvalued Indian currency. That aspect has got corrected. We have depreciated to 88 and now at 85. And if US dollar was to depreciate, obviously they'll look to protect the value. India will be one of the highest growth rate countries in the world, even now 6% real GDP growth. Inflation is quite benign. Liquidity is easing at the margin. Plethora of opportunities in the Indian markets, and domestics are also participating in. So where will you get a country which is growing at 6% in real terms and you are able to diversify out of India? Obviously, there is one aspect which needs to be catered into, which is valuation. In India, nothing is worrisome except the valuations. I would believe that if you are able to take care of the valuation and are certain about the growth on these companies, I mean, there is no case for being bearish in India. And the second biggest asset allocation will be your gold. And the third largest would be basically your duration on income, which is basically you're looking at 50 to 75 basis point cut in rates in India. And The difference between US interest rates and Indian interest rates have never been so conducive as far as India is concerned. The spread has narrowed significantly, which highlights the strength of Indian economy vis-a-vis the rest of the world.
Okay. Nishal ji, do you think there is a case for the RBI to again cut rates then, looking at what is, how things are changing on a macro space?
I think RBI has already bit that bullet earlier. Basically, I think now there is a very strong case basically to go ahead and keep on doing that. I was a bit skeptic in the first rate cut because at that time, basically, given that you had a huge pressure on the rupee,
Yeah.
so I was a bit skeptic at that time. But I think given that we have bit the bullet there, I think you look at each of these steps basically which RBI is taking, rate cut, introducing liquidity. So I think RBI is supporting. They have understood basically that now is the time to go out and support the businesses, support the economy, and that's what they're doing. So very sure basically that there is going to be a rate cut in April.
Okay, fair point. A very short bullish expectation or optimism as far as a rate cut possibility in April is concerned. So that's something that's the next big trigger that the Indian markets will be watching out for days from now, and we'll be focusing on that. Manishi, you talked about three key themes: consumption, pharma, BFSI, where you're bullish on. Tell us how would you be really going about selecting stocks within the portfolio now? Would you be allocating more money here? What exactly is the thought process on this space, especially on consumption? Because why I'm asking this is April 1st has started off. This is when the budget announcements were really focused on reviving consumption, putting more money in the hands of people. Where do you think in consumption one should be focused on to take that benefit?
Yeah, so the pendulum has shifted away from investment-related themes to consumption-related themes. Broadly, if you see that, April to February numbers on capex, etc., we'll be barely meeting that 10 lakh crores mark for fiscal 25. Valuations still prohibitive as far as the investment-related themes are concerned. You have a tax saving of 1 lakh crores, particularly for people who have income less than 12 lakh rupees. Obviously, discretionary consumption is the one which is going to benefit. So whether it be, let's say, durables, whether it is Medicaid, or whether it is your two-wheelers or automobiles. And mind you, the full-blown impact or positive impact is not going to be seen immediately in 1 or 2 quarters, but the second half of this year. And you'll start to see the rub-off effect of all these things. Rural economy is also coming back. And I'm not so bearish even on the staples piece now. Given that valuations have corrected, you will have income in the hands of people, particularly rural income. These are going to be benefiting at the margin. You look at hotels, you look at travel, you look at some of the leisure, entertainment. These would be some of the areas where I think consumption, QSRs, these will be some of the areas where I'm particularly quite bullish on consumption, discretionary more than staples, urban
Okay.
more than rural.
Okay, fair point. Nishal ji, you also mentioned so many themes, including cement and all the domestic focused sectors. Why don't you give us some names? What kind of select names can we really look at adding to our portfolios now?
So I think a couple of themes which I was talking about is the government spending,
Hmm.
and there are two or three sectors basically which continue to do well. Power is one of them. I think the orders have been huge, especially on the T&D side. So there are several companies out there, and I think one can look at that. There is then the domestic construction companies again, where there are huge orders. Cement is a beneficiary again there. So I think these two, three themes, one can look at it. On the consumption side, I think we are seeing good traction coming back. At least a couple of companies were declared the third quarter, not the numbers, but at least the business update. They have said that at least they are seeing some traction on the rural as well as on the urban side. So I think some of these companies on the retail side should be looked at. So I think these are three to four domestic themes one can play.
Okay, Nishal ji, tell us also what remains in the avoid list or a complete caution where you would continue to advise, sir.
So I think export oriented IT is one of them. Basically, I wouldn't say avoid, but I think it is on a cautious list because the sector has corrected quite a bit. That is one of them. And anyway, the sector had an issue as far as earnings was concerned for the next year. So I think that is a caution thing. Auto is another one. We have to see basically how the tariffs settle. So I think these are two or three sectors. Gems and jewelry, we hardly have anything which are, there are no big exporters which are listed. So that's why we do not have much of issues. Textile is another one. Basically, we have to see if these are three or four sectors basically which are directly impacted. These are three, four sectors basically one should look at. Specialty chemicals to an extent, we have to see how things pan out there. So these are four, five sectors one should be cautious about.
Okay. Manish ji, how about you? What would you absolutely not look at from here on for the next at least 6-8 months?
I think autos are a complete avoid and capital goods. These would be the two vulnerable areas, more so on account of the capital goods space, etc. More so on account of valuations. They are still a hindrance, and automobiles, obviously, the main brunt of US is basically centered around automobiles and auto components, and India has a large portion of export to the US in terms of auto comps. So this is one area would be clearly an avoid. Renewables, again, valuations major issue, plus the dumping duties which are now being introduced, reciprocal tariffs, plus what is going to happen with China introducing and dumping worldwide. These are some of the major questions left to be answered, but at this point in time, these would be basically valuation issues, clear avoid sectors.
But Manishi, I have to ask you before I let you go both. You both are pretty bullish on India henceforth, and you do believe things will turn for the better. FIIs to return, and of course, India being seen as one of the brightest spots for investments at this point in time. What are the chances, Manish? Do you see us touching those erstwhile highs, 26,277, sooner than we expect, sir?
We will see it in FY27, give or
Okay.
take a few months here and there, but definitely 26,277 is par the course, even with the 10% sort of a growth in corporate earnings in FY27. FY26, in any case, we are building 12% sort of an earnings, so 10% should be par the course, given that nominal GDP is growing at 10% levels.
Okay.
Those levels are clearly doable in FY27, 1.5 years down the line.
1.5 years down the line, we will be hitting those erstwhile highs. Nishchalji, what about you? What's the best case scenario for expectation, or what kind of returns can we expect on the markets for FY26? We've begun with all this uncertainty. How do you expect the year to pan out?
I think first half anyway we were saying basically there is going to be a challenge. So I think that challenge just deepens with this tariff issue. Second half there is going to be a general recovery because of whatever the measures the government has taken. So I think I continue with that stance. I don't see any challenge there. So second half is where you're going to see. I think current year should be happy basically with a 8-10% kind of a return. And I agree with Manish basically. I think next year only you will see a new high.
Next year only we'll see a new high. All right. Thank you so much then, Mr. Manish Sonthalia, Director CIO, MK Investment Managers, for being with us on this special broadcast. Also, Mr. Nishal Maheshwari, market expert, joining in with all your important insights, your valuable views on the markets, and of course the impact of Trump's tariffs. It's been an important day and will continue to be for all of us to really look at the fine print. Hope you have a great day. Till the time we see you next very soon on another edition of Business Today Television. Thank you to both of you.
Thank you.
All right, viewers.